Hello and welcome to session 8 of our basic group accounting course. Make sure that you've covered sessions 6 and 7 because that taught you how to deal with different types of consideration paid for a subsidiary. In this one, we're going to have a go at each of them. So you can see here that we're just doing illustration 6. We've got cash, shares, deferred consideration and contingent consideration. There is a pro forma for you in the workbook, which of course you'll need to have downloaded, I'm assuming that you've done that. So for each one, you'll need to do the working here. So what's the working? And then the journal entry to record it. So that's the cash, then the shares, then the deferred consideration, then the contingent consideration. So work it out and then post the journals. Then it says, what is the subsequent treatment? Well, you'll need to work through the unwinding of the discounting on the deferred consideration and the unwinding of the discounting on the contingent consideration. Same as we did in the session, just to charge that amount to finance costs each year and increase the balance on the liability. So debit P&L, credit liability to increase it each year. Have a go at each of those and all of the treatments. I'm going to get you to pause the video now, have a go at them, and then I will take you through them. So just do your best, give it a good go, and I'll come back to you in just a moment to work our way through it together. Right, okay, hopefully you've had a go at this. Let's take it one by one. So we've acquired 75% of beta. The consideration was 300,000 of cash paid immediately. No working to do for that one. 300,000, there it is. The double entry for that is going to be debit goodwill. Remember that increases the goodwill. And the credit is going to be to cash. And each of those is just going to be for the 300 because that is how much we're paying. So that one's really simple and straightforward. We've got cash payment, just do it at the amount paid. Okay, next one, shares. 50,000 shares with a fair value of $6 each, nominal value $2 per share. Okay, so we know that we do this at the share price. So 50,000 shares times $6 each. So that again is 300,000. The journal entries will be debit goodwill. Remember, we know that the debit always goes to goodwill. So the total amount will be 300. But it needs to be split between share capital and share premium. Okay, and the share capital will be 50,000 shares times the nominal value, which in this case is 2. So that's 100,000. And then the balancing figure will go to share premium. So that's 200,000. Okay, so just be careful on the split, but we work it out at the market price. And then we debit goodwill with the total. The credit is split between the share capital and the share premium. Share capital at the nominal value, share premium with the balance. Okay, now we've got the deferred consideration. 200,000, 3 years time, 8% discount rate. Okay, so the calculation for this one is the amount, which was 200,000 multiplied by 1 over 1.08, so that's 1 plus the discount rate, to the power of, how many years was it? 3 years. Okay, when you do that calculation, now there might be a little bit of rounding in here, but it's going to come out at something in and around 158767 or thereabouts. The journal entries for this one are we're going to debit goodwill as usual, and we're going to credit a liability. Okay, with the total 158,767, debit goodwill, credit a liability. That is our deferred consideration done. We'll think about what we do subsequently in just a moment. The contingent consideration then. So contingent consideration, 100,000 in 2 years, discount rate 8%, and a 70% probability that they'll hit the performance targets. So similar to deferred in that we start by doing the discounting. So, sorry, it's disappeared there. Okay, the discounting is 100,000 times the discount rate is 8%, and the number of years is 2 years. So similar to the one above, actually, except it was 3 years. So times 1 over 1.08, this time to the power of 2. And then finally times 70%, because there's only a 70% probability that it happens. So when you do all of that, you should get something around 85,734. Same as this one in terms of the journal entries. So we're still doing goodwill and the liability for the full amount of the 85. So that is the treatment initially for our contingent consideration. Each of these will be going to goodwill, so they'll go in. If you had all of them in the question, you'd add them all up and that would be the total consideration. And then the other side of them depends on what it is. It's either cash, share capital and share premium, or a liability. Don't forget though, if you have created a liability for deferred or contingent consideration, we do need to unwind the discounting. So the subsequent treatment for the deferred consideration first. So the deferred consideration started off at 158,767. We're going to unwind it at 8%. So remember, it's going to be debit P&L, credit the liability. So 158,767 times 8%. So that's going to be 12,701. Which means the closing liability, because remember the credit is to the liability, is going to be 171. That becomes the opening for the next year, and then we do it all again. Okay, so for the 3 years, we're going through, we're calculating the opening and the closing, and remember the entries here are going to be debit finance costs in the P&L, and credit the liability. You are increasing the liability over the number of years until it's paid. You are reversing the discounting that you did above. Okay, I know it's one out at 200,001, but that's just rounding. Same again for the contingent consideration. So it starts off at the 85. And then we unwind the discount. It was the same discount rate, it was 8%. So actually you could just do it. Paste that in. Which means at the end of year 1, we had 92,593. That becomes the opening balance for the following year. And then we do it all again for year 2. And it was only 2 years. So that by the end of the 2 years, the liability is sitting there at 100,000 and you pay it. And just thinking about that, when you actually pay that, what will happen is that you will debit the liability and you will credit cash when it's paid. Okay, so when it's paid, those would be the entries to get rid of the liability. So obviously you need to build the liability up over the number of years by unwinding it, or else it won't match. If you had left it at 85, well then by the end you would still have 85 sitting there, but you'd actually pay 100. So that's why we have to do this bit to unwind the discounting that we did, and we take it to the P&L each year as a finance cost. Okay, so that was session 8. You should now be able to deal with all of our different types of consideration, and then we'll move on in session 9 to look at some other aspects of group accounting.